Principles of Accounting, Chapter 16. In Chapter 16, we look at financial statement analysis. One of the reasons that we do financial statement analysis is so that we can do comparisons of financial statements of companies that are in similar industries but might not be similar size. By doing this, we change dollar information to percentages. This allows us to see what kind of trends are happening with their business, if their costs are increasing as a percentage of their income. And then we do ratio analysis, looking at various ratios, and every ratio tells us something different about the organization. So the three main types of financial statement analysis are horizontal analysis, or dollar and percentage changes on statements, vertical analysis, which is a common size statement, and ratio analysis. The dollar and percentage changes on statements, or the horizontal analysis, shows us trends from year to year. This gives us information about what is increasing or decreasing for a company from year to year. So this shows information about 1 year to the next year. When we see financial statements, most companies give out multiple years of information. This allows us to look at 5 to 10 years of information and look at trends in their information. So for this example, we have a balance sheet, 2 years of information, and we're looking at the difference between last year and this year. When we do those calculations, we want the current year figure minus the base year divided, and that gives us the dollar change. We take that dollar change and take it times 100%, as we'll see on the next page. So turning it into a percentage, we take that dollar change base year figure and take it times 100%. So we can see here now that we've done that to this balance sheet, and this is just the assets section of the balance sheet. But we have that from this year to last year, we had a decrease in the amount of cash in our cash account, and that was a 48.9% decrease. So we take this year minus last year and then divide the difference by last year and take that times 100%. We can also do that for the income statement. So we see the difference in sales from 1 year to the next, if we increased or decreased, and what kind of changes that we had. So we can see that we increased sales by 8%, but our cost of goods sold went up by 14%. That made our gross margin decrease. We also look at trend percentages in horizontal analysis. So the trend percentage is the current year amount divided by the base year amount times 100%. This is where we set everything as a percentage of a base year, usually whatever the oldest year is of the information that we're looking at. So if we're looking at financial statement analysis from 2005 to 2020 for an organization, 2005 would be our base year. We can see this income statement information for 5 years. Year 1 is our base year, and then we show everything as a percentage of change in base year. What we can see is that our sales are trending up. All of our information is trending up from year 1 to year 5, but we want to see usually also in what percentage is cost of goods sold going up as a percentage to sales. We would hope that they would go up in relation to each other and that our cost of goods weren't increasing more than our amount of sales were increasing. We can then graph the information from our trend percentages, and we can see how that information is going up. We do see that the cost of goods sold have been increasing from years 3 to 5 at a higher rate than our sales have been, which makes our gross margin not increase as much because we have a higher cost. We also do vertical analysis. When we're looking at vertical analysis, we change everything to a percentage as expressed in an item on that statement. On balance sheets, everything is expressed as a percentage of total assets. Total assets is 100%, and everything else is shown as a percentage of total assets. On the income statement, that is sales. Sales is 100%, and everything else on the income statement is shown as a percentage of sales. So you can see that we have 2 years of information here for an income statement. These are called common size financial statements when we remove all of the numbers from financial statements and turn them into percentages. So this year we had net income was 3.4% of our sales, and last year it was 4.7 as sales. So you can see as our costs have increased that the net income has decreased. In addition to looking at these percentages where we changed the financial statements, the income statement, and the balance sheet to either vertical common size percentages or horizontal trend percentages, we're trying to look at the story of this organization and also in order to compare it to other organizations within its same industry. So we would want to look at what are other organizations in this industry and how do they compare? Is this something that's common across all businesses? Is this just a trend where we're seeing the cost of goods increasing in all industries? Or is it an indicator that this business might be having some issues that are need for concern? Financial analysis, banks will look at this information to determine if companies are a good investment. We also do ratio analysis. We've talked about some ratios throughout all of Principles 1 and Principles 2. Some of the more common ratios that we've looked at, such as return on assets, asset turnover ratio, gross profit margin. So here we have an income statement for 2 years. We also have a full balance sheet for this organization, and this is the information out of the textbook. When we're doing ratio analysis, ratios tell us different things. We're going to start with liquidity. Liquidity ratios include working capital, current ratio, and the asset test or quick ratio. What liquidity tells us is information about our cash flows and our ability to pay our debts quickly. So how liquid is the company? Working capital is the amount of current assets over current liabilities. So working capital is current assets minus current liabilities. That's the working capital information that we have. Most working capital is financed with long-term debt and or equity. And companies will have to choose whether they want debt financing or equity financing and which one is more advantageous to them. There is a financial formula for what your debt to equity ratio should be for an organization, and looking at working capital, you will learn those formulas in business finance. The current ratio looks at a company's ability to pay short-term debt. If the ratio is declining from year to year, that can show that we have bad financial conditions, or it just might be a factor of our inventory valuation. So another thing that's impacted by ratios, and you would want to look up for a company, is what kind of inventory evaluation are they using? LIFO, FIFO, or weighted average? Difficult to compare sometimes a company that's using LIFO to a company that's using FIFO for inventory valuation. The current ratio is calculated by taking current assets and divided by current liabilities. We, of course, want that number to be higher than 1 because we want our current assets to be higher than current liabilities. The next ratio is called the asset test ratio or the quick ratio. It's similar to the current ratio, except that it removes inventory calculations from the current ratio. So we use quick assets, and quick assets are cash, short-term securities, accounts receivable, and short-term or current notes receivable. So this is how able are we to pay off our liabilities without having to remove inventory in order to do it. So this is our quick assets divided by current liabilities. We want this number to be higher than 1 in all situations, and we would not want to see a declining trend. The next set of ratios are for asset management. How are we utilizing our assets in order to generate sales? So how are we utilizing our inventory, our equipment, our buildings, etc., to generate money for the business? We start with the accounts receivable turnover. So this tells us how many times per year we convert our accounts receivable into cash. The formula for this is the sales on account divided by the average accounts receivable. So the average accounts receivable is year 1 plus year 2 divided by 2. We can see here that this company has turns their accounts receivable over 26.7 times. This is also a number you would not want to see changing too much because it can indicate that you are having cash flow problems, that you're not able to collect cash from your customers. Average collection period is 365 days or 360 days, which is the accounting year. Different textbooks ask for different things, either 365 days or 360 days. This textbook uses 365 days, but the business finance textbook uses 360 days. So it's 365 days divided by your accounts receivable turnover. This indicates how long it takes a customer to pay their bill if they buy something on account, on average. Again, this is not something that you would want to see increasing because it shows a liquidity issue in your ability to generate cash and collect on those accounts receivable. Inventory turnover ratio shows how often your inventory is sold and replaced during the year. You want it to be around industry average. Different industries are going to have different turnover ratios, and whether that's good or not really depends on the industry. You're going to see, for example, a car salesman or a car company is going to turn over their inventory less often than, say, a grocery store will. So inventory turnover is the cost of goods sold divided by average inventory. And that average inventory is year 1 plus year 2 divided by 2. Or year 2 plus year 3 divided by 2, year 3 plus year 4, but the years that you're looking at. We also have the average sale period. This is the average number of days that inventory sits on our shelves. We take 365 days and divide it by that inventory turnover that we calculated from the last slide. Our operating cycle is the time from when we receive inventory from suppliers to when we receive cash from our customers. So we take the average sales period plus our average accounts receivable collection period and add them together, and that is our average operating cycle. Then we have total asset turnover. Total asset turnover is the last of the asset ratios. This ratio is looking at how we use our assets to generate sales. It includes all assets, so current and long-term assets. It's sales divided by average total assets, and then that average total assets is 2 years assets divided by 2.